morning, Real ECN listeners. This is your weekly FX market update brought to you by Real ECN. In today's commentary, we will explore the Euro-dollar market. So last week, Portugal's bank scare heated up speculation of a trigger in risk aversion during a time where market volatility is at record low. This week is packed for a market-moving risk event out from both the Eurozone as well as the United States. These risk events will likely induce a degree of volatility in the price action of the Euro-dollar pair. First, in line with this commentary, we will touch base on the Euro-dollar pair on two fronts, the technical as well as the fundamental front. Here, let's first explore the technical front of the Euro-dollar pair. Here we have the Euro-dollar charted on a daily chart. The price action for the Euro-dollar pair during last week's trading session appeared to have been trapped within the 1.3600 boundary. Volatility is expected to pick up on the back of a string of risk events out from the Eurozone and the United States this week. The Euro-dollar pair peaked out slightly north of the 1.3645 mark during last week's trading session and later corrected to the downside. Currently, the pair is trading above the support tier set up at 23.6% Fibonacci retracement at the 1.3583 zone. Failure to sustain trading momentum above this level will expose the pair to the next support tier set up at 38.2% retracement at 1.35117. However, in the case that the bull can overpower the bear heading to this week's trading session, the pair may likely retest a former support tier resistance at 38.2% Fibonacci expansion marked by 1.3689. So in accordance to the SSI, which is commonly known as the Speculative Sentiment Index, retail open long and short positions are beginning to show sign of diverging. In addition to that, retail traders are piling onto net short Euro-dollar position with net short interest sitting at 2-to-1 ratio to long interest outstanding. The contrarian standpoint to this cross sentiment would suggest near-term bounce in the single currency following a correction to the downside. Analysts also believe that due to the record low FX volatility, the single currency will most likely continue to remain trapped within the trading range of 1.3700 to the 1.3580. So moving down here, we have the Euro-dollar pair charted on a 1 hour time interval. Analysis of a collection of technical indicators on the hourly time interval on the Euro-dollar cross is suggestive of a temporary bearish market sentiment and recommend long positions on the greenback. The Euro-dollar cross opened today's Sydney trading session slightly on the established Fibonacci support at 1.3600, while the Fibonacci resistance is set at 1.3606. Since last week, Euro-dollar correction to the downside, the pair also broke below the 200-day simple moving average in the process. Since the Euro-dollar cross opened today's Sydney trading session below the 200-day simple moving average, this is very indicative of long-term bearish outlook on the cross moving forward. This bearish standpoint is also validated on the short-term moving average front as the pair opened today's Sydney trading session below the 5, 10, 20 and 30-day simple moving average, which is indicative of a solid recommendation on the moving average front. So moving along to the fundamental aspect of the Euro-dollar pair, a new concern arising from the Eurozone has held a great deal of fundamental significance on the single currency as well as the turnaround on the VIX, was stemmed from a mini crisis in the sell-off in one of Portugal's commercial bank. The mini crisis highlighted the weaknesses in the European interconnected banking system as well as the sovereignty of the peripheral countries. In recent years, the lending rate for these peripheral European nations has fallen to record lows, comparable to pre-crisis level, which is self-evidence that risk appetite was the prevailing theme in the marketplace. Traders are monitoring the yield curve on the 10 years Portuguese bond to see whether this mini banking crisis in the country will have a contagious effect on other European banks, or will it likely be diffused in following weeks. The performance of the European bond yield curve has been one of the underlying reasons to why the euro has remained supported against the greenback despite the implementation of aggressive easing policy by Mario Draghi. A rising yield curve of these countries will be reflective of investors profit-taking or no longer attracted to these peripheral bonds investments, and this shift in sentiment is one of the spark traders are keeping an eye out for to gauge the timing of risk aversion and the long-term decline in the single currency. Unlike last week, this week is packed full of numerous risk events that will likely trigger a certain degree of volatility in the price action of the euro-dollar pair in this week's trading session. On Monday, the market can expect ECB President Mario Draghi to testify to Parliament. Investors has already seen the announcement of aggressive easing policy, which include interest rate cut and termination of bond sterilization program by Draghi. However, what they are anticipating next is whether Mario Draghi language will signal further expansion in ECB balance sheet, but which will prove to be detrimental in the long-term outlook of the single currency. Also on Monday, the Eurozone is expected to release industrial production month-on-month, expected to contract by 1.2%. On Tuesday, investors can anticipate a series of investor sentiment prints, starting off with the Eurozone ZEW economic sentiment expected to tick in at 62.3, while the German ZEW current condition is forecast to read at 67. In addition to that, the German ZEW economic sentiment is forecast to come in at 28. On Thursday, the market can expect Eurozone Tier 1 leading economic indicator, which include the core CPI year-on-year reading forecast at 0.8%, while CPI year-on-year is reported to come in at 0.5%. Lastly, the Eurozone month-on-month CPI number is expected to tick in at 0.1%. Over the United States, recent month overall weaknesses in the greenback is a mere reflection that investors' interest rate expectation on the greenback has pulled back significantly. On Tuesday of this week's trading calendar, Fed Chair Janet Yellen will testify in front of the Banking Committee. Investors are closely monitoring the Fed's chairman's language to see how her forecasts have changed, if not at all, with regard to a pickup in the US labor market as well as inflation. In the case that Yellen rhetoric will remain anchored to the status quo, it is likely that the greenback will remain muted against the euro. Also on Tuesday, the US is expected to release its core retail sale month-on-month print, forecast to expand by 0.6%, while its retail sale month-on report is expected to tick in at 0.3%. On Wednesday, the US is expected to release its PPI report month-on-month, forecast to expand by 0.2%. Producer price index is a great measurement of inflation forecast. On Thursday, investors can anticipate the US building permits report to pick up at 1.040 million, as well as the Philadelphia Fed Manufacturing Index expected to tick at 16. Thank you everybody for your time, and have a successful trading session this week.